Hi, Joe. It's really good to be able to speak to you again. And this is a very exciting time. You've obviously been very busy, and this week you've actually now released the results of your feasibility study for your phase one lithium project, which incorporates both mining operations in Namibia and a processing plant in Abu Dhabi. For our listeners, it would be very good if, first of all, you could just describe what the project looks like, what are these activities, and then give us some highlights from the feasibility study and what is actually particularly relevant to investors.
Good morning, Ian, and thank you. Yes, it has been quite a period for Lepidico. It represents the culmination of about 6 years of work, this definitive feasibility study. It's based on the redevelopment of 2 mines in Namibia. They'd previously been mined for tantalum and petalite. We're now looking at developing them for the lepidolite content that they've got there. And there'll be small-scale mining operations. It's very small footprint. The lepidolite ore from the mines will then go to a relatively small-scale concentrator that employs industry standards technology flotation to produce 2 concentrate streams. There's a lepidolite concentrate stream and an amblygonite concentrate stream. The product will be trucked from the mine site down to the port of Walvis Bay. From there, it will be shipped to Abu Dhabi, where we intend to build our chemical plant. And this is the chemical conversion plant that treats the lithium mica, lithium phosphate concentrate and converts it into the chemicals. And it's that plant that employs our proprietary process technologies, LMAX and LOMAX. The integrated project there has been demonstrated to have really attractive fundamentals. We've got an internal rate of return of over 30% as defined by the feasibility study, and an NPV at an 8% discount rate of $221 million US. So very compelling fundamentals to the project, and compelling competitive operating costs and a competitive capital cost structure as well.
Thank you, Joe. And so, with respect to the specific project and the IP, the intellectual property associated with that, because it's quite unusual, what sets this project apart from other lithium projects around the world?
Yes, it is a very different project, Ian, and that is a result of our LMAX and LOMAX technologies. They're employed in the downstream chemical plant, which we're planning on building in Abu Dhabi. And they allow a hydrometallurgical solution for getting from a lepidolite concentrate to the various chemicals that we're looking at producing. The capital intensity associated with the project as a whole is very competitive despite the more modest scale. And the operating costs are at the bottom end of the cost curve as well, after we take into account the byproduct credits. And those byproducts represent about over 30% of total revenue. So they are important to the project, and there's a significant amount of capital in the plant to be able to produce those chemicals. Upstream in Namibia, the point of differentiation there is the mineral we're looking at producing or processing, which is predominantly lepidolite. It's a lithium mica mineral. And our process technology is specifically designed for the treating of lithium mica and lithium phosphate minerals, which up to this point have been largely overlooked as sources of lithium. And the other point of differentiation here is lepidolite is the only realistic source of economic rubidium, and it also provides a source of caesium.
Thanks, Joe. Very interesting. So could you tell us how the pilot plant campaign that you're embarking on here is, how is that going to help de-risk any potential commercial size project?
The pilot plant we commissioned and operated last year on our first campaign. It was an extremely successful initiative. And the plant operated around 15 kilograms per hour. The phase 1 plant is designed at 6.9 tons an hour. So that's about a 460 times scale up, which by industry standards, isn't a large scale up. And I think it's also very important to note at this point that this again is a hydrometallurgical process. We do not have a complicated large scale pyrometallurgical front end to this process, like for example, spodumene conversion processes employ. So that scale up is really about chemistry, and we know that the chemistry from the pilot plant campaign is extremely robust.
One of the things obviously that many investors are aware of today is the lithium price is nothing like as strong as it has been previously. Given your specific project, how much is that going to be relevant, especially to how fundable your project potentially can be?
It's a really good point, and we've clearly been in a challenging market for the last couple of years for lithium. The chemical prices have been in decline, and particularly spot prices. But I think it's really important to remember here that this is really a contract market, and the contract prices for lithium chemicals are significantly higher than the spot price implies. And we envisage that we'll be entering into long-term binding contract prices for all of our major products. The price that we've used for the definitive feasibility study is independently provided by Benchmark Mineral Intelligence. The long-term price there is just under $13,000 a ton. Contract prices for lithium hydroxide monohydrate are still not far off that. They're probably maybe $11,000 or $12,000 a ton. The spot price, by comparison, is below $10,000 a ton. But I think that the other important point in all of this to remember is that we do have a competitive operating cost to the project. So when it comes down to fundability, I think that even though we are in the low point of the cycle, we have got an eminently fundable project. And to that end, we've announced recently that we've got some very constructive engagement with development financing institutions and commercial banks, and also export credit agencies. So we expect that over the course of the next 9 to 12 months, we'll be putting in place a comprehensive financing package for the project, which will involve a reasonable proportion of project debt.
Joe, that's really interesting. One thing I'm just picking up on what you talked on there was the importance of the byproducts in the project, which you mentioned earlier as well in this interview. Can you tell us just how significant those byproducts are to the project, and I guess also to the fundability of the project?
The byproducts are important, and I think it's important to remember here that the scope of this project has evolved over the course of this definitive feasibility study. When we did the pre-feasibility study back in 2017, we didn't at that time contemplate production of caesium and rubidium chemicals. It's very clear now that those metals are not just critical, but they're also of strategic significance. The United States, for example, is 100% reliant on imports, and most of the mines that have been producing caesium in particular are now depleted. So our project represents one of the very few opportunities around the world for new supply of both caesium and rubidium. So we've engineered those now into the chemical plant design. And there's a meaningful amount of capital in the plant to be able to produce those. So this isn't just a lithium chemical project. It is really more of an alkali metal project where we produce lithium chemical, caesium, rubidium, and then obviously the potassium reports out as SOP fertilizer. And all of those products are important to the economics, but they do drive still very competitive capital intensity to the project, and also competitive operating costs.
Now looking forward, now that the DFS results are out, what are the next major milestones for you and for investors, and when do you anticipate that the project could actually enter production?
So we've obviously achieved a major milestone with completion of the definitive feasibility study, and as the name suggests, it is a definitive body of work. So we've already done some front-end engineering and design work, so we're well advanced on that. The critical path now is really pulling together that full funding package for the project, and binding offtake arrangements for our major projects, the lithium, the caesium, the rubidium, and then getting our environmental and social impacts assessments completed. To that end, we're very well advanced on the project component within Namibia. That part of the project is also fully permitted, and the ESIA should be complete this July. The ESIA for Abu Dhabi is likely to be completed around year end. And then we envisage that the funding and offtake will be in place by around April or May next year. And we have made some allowance in that timetable for the current pandemic situation. So if we can be making a final investment decision around April, May next year, we'll then be looking at commissioning the mine and the concentrator in Namibia in the second half of 2022, and commencing chemical production in Abu Dhabi in the first half of 2023.
That's really interesting, Joe. Actually, just as a final point before we shut this down, you mentioned two ESIAs, one in Namibia, one in Abu Dhabi, and clearly environmental impact for investors today is hugely important with the growing ESG theme. Can you just briefly describe for us the environmental footprint of the project? What are the key environmental issues, and why, from an ESG perspective, this is a good project for investors to be looking at?
It's a very important point, Ian, and it's the phase one project does have excellent ESG credentials. In Namibia, as I mentioned earlier, we're looking at redeveloping mines. So these are disturbed mine sites that have never been formally closed down. We've already done full closure plans for them. So we're well advanced on all of that. So we should leave these sites in better shape than what they actually are today. The social side's important as well. We'll be employing about 115 permanent people in Namibia. We'll be employing about 119 people in Abu Dhabi. The carbon footprint of the project is low, and it's particularly low vis-a-vis other lithium processing technologies. So our carbon intensity, we would expect, will be 5 to 7 tons of CO2 per ton of lithium hydroxide produced per annum. And we're not taking full credits in there for the byproducts as well. So I'm confident that we'll be able to get that carbon intensity down. So I think that there's a real opportunity to be producing probably some of the world's lowest carbon intensity lithium chemicals from this phase one project. So we're going to pull all of those environmental and social elements together in these environmental social impact assessments that we're going to be finalising. The first one in Namibia in July, later on in the year in Abu Dhabi. And I believe that those are going to allow us to secure some very competitive funding for this project.